Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last lecture, we used the VWAP to find the exact average execution cost of institutional capital. But to predict where a stock has room to run, or where it will hit a brick wall, we have to know where historical shares are currently sitting on the y-axis. Today, we are going to analyze stock float and chip distribution. Before we look at the chart, we must define the float. A company's float is simply the number of shares actively available for public trading. Mathematically, a stock with a tiny float, say under 20 million shares, requires very little volume to move the price. It is highly volatile and easily manipulated by chat rooms. In our quantitative framework, we do not treat this. We strictly filter for stocks with a float of over 50 million shares and a market cap of at least $2 billion. We only want structures driven by real macroeconomic forces. Let's look at the trading terminal. For any trading app, if you want to turn on the chip distribution, you can find somewhere here for the market position overview. And then you click it, then you can see the distribution for any day or any week you want, or any minute. Okay. So suppose this is, suppose let's look at the daily chip distribution for NVIDIA. Advanced platforms use proprietary algorithm to estimate where those floating shares are currently held. This is called chip distribution. Now I need to give you a very strict quantitative warning. VWAP is an exact math formula. Chip distribution is an estimate. Like this. Your broker cannot see the private ledgers of Citadel or BlackRock. They are using algorithms to guess the market's cost basis. Therefore, these support and resistance zones will look slightly different depending on what app you use. We use these bars to gauge general market sentiment, not exact to the penny levels. Look at the shape of this distribution. It is color-coded. The red chips represent overhead supply. These are traders who bought higher than the current price and are bleeding money. Red chips act as a heavy resistance ceiling. Why? Because when a stock finally relies back up into those red bars, those trapped retail traders will aggressively sell just to break even, which kills the rally. Conversely, the green chips represent profitable shares, usually accumulated by heavy institutional algorithms. Green chips act as general support. If the price drops into a dense block of green chips, like here, these institutions will often step in to defend their profitable positions. Let's get back to the lecture. So those chips are not static. They move through a specific three-phase cycle. Okay,
So here are the comment I said before. And now I'm going to talk about this three-phase cycle. Phase one is accumulation or absorption. Following a bear market, chips become densely concentrated at the very bottom of the chart. Institutions are quietly buying up all the shares from panicked retail traders. Phase two is the markup or transportation. The price violently breaks out upward because the chips are all at the bottom, leaving a vacuum of air above it. Then phase three is distribution. The dense cluster of chips migrates from the bottom to the absolute top of the chart. Institutions are dumping their profitable shares onto euphoric retail traders. Once you see a massive block of chips form at the top, the trend is exhausted. So, how do we actually trade this? We do not use this as an exact execution trigger. You never blindly buy just because the stock touches a green bar. Instead, we use it as a structural filter to keep us out of bad trades. First, we check the profit ratio in the corner, like here. Okay, it is the ratio that the green parts, comparing to the red parts. If it is below 30%, the market is drawing in red chips, we avoid it. Second, we watch out for the red ceiling. If your moving averages give you a buy signal, but the candlestick is pressing right up underneath a massive wall of red chips, you vital the trade. The break-even sellers will crush it. If we look at this figure, there are some uh, price right here, but you see that the support in this example is much higher than the red. Okay, for example, the length and the density means how the support level, roughly speaking. Okay. And finally, we'll avoid the consolidation trap. If the daily candlestick is trapped perfectly in the middle of a massive block of chips, the stock is chopping sideways. We wait for it to break free into open air before deploying our capital. All right. Chip distribution gives us a macroscopic map of where the market is trapped. But what if we want to measure the aggressive real-time pressure of market orders hitting the tap right now? In our next lecture, we are going to look under the hood of order flow with the cumulative volume delta. See you in the quant lab.